Hello everyone, this is Nick. Welcome back to the third video of our series breaking down Benjamin Graham's classic book, The Intelligent Investor, which Warren Buffett calls the best investing book ever written. Today we are diving into chapter 2, titled The Investor and Inflation, where Graham tackles one of the most critical challenges every investor faces: what to do in times of inflation. This chapter is especially relevant today as we have seen inflation make a dramatic comeback in recent years. If you are new to the channel or just discovering this series, here is what it is about. I am going through The Intelligent Investor chapter by chapter, breaking down Graham's timeless wisdom into digestible, practical lessons you can actually use. If you are finding value in this series, make sure to subscribe and don't forget to click the little bell icon. That way, you'll get notified every time a new video in this series drops, and you won't miss any of Graham's invaluable insights. Let's start with this chapter. On page 47, Graham begins the chapter like this: Inflation and the fight against it has been very much in the public's mind in recent years. The shrinkage in the purchasing power of the dollar in the past, and particularly the fear or hope by speculators of a serious further decline in the future, has greatly influenced the thinking of Wall Street. It is clear that those with a fixed dollar income will suffer when the cost of living advances, and the same applies to a fixed amount of dollar principal. Holders of stocks, on the other hand, have the possibility that a loss of the dollar's purchasing power may be offset by advances in their dividends and the prices of their shares. As Graham explains, inflation is a critical challenge. Here, there are two main takeaways for investors. The first takeaway is about the vulnerability of those with a fixed income, while the second one addresses how stocks can potentially serve as a defense against this silent tax. Graham's first point is a very important one. Individuals with a fixed dollar income are hit hardest by inflation. Think of it this way: your salary might remain the same, but the cost of everything you buy, from groceries to gas, is rising. This means your purchasing power is shrinking, even though the number on your paycheck hasn't changed. Inflation acts as a silent tax on cash and fixed income assets like bonds or saving accounts, because the real value of these assets decreases over time. For example, if you have $100 in a savings account earning a 1% interest rate, but inflation is at 5%, the real value of your money is actually declining by 4% per year. You are effectively losing money. And speaking of how inflation affects our daily lives, here is a humorous take from the commentary of the chapter that really drives the point home. Americans are getting stronger. 20 years ago, it took 2 people to carry $10 worth of groceries. Today, a 5-year-old can do it. It is funny because it's true, isn't it? That joke perfectly illustrates how the purchasing power of our money has diminished over time. This leads us to the second takeaway. Unlike fixed income assets, stocks offer a high possibility of offsetting the effects of inflation. However, it is critical to understand that this is not a guarantee. A stock is simply a piece of a business, and only well-run businesses with strong competitive advantages have the power to truly fight inflation. Graham suggests that by owning shares of a good business, you have a stake in a tangible asset that can adapt to changing economic conditions. In essence, the value of the underlying business can grow with inflation, potentially protecting your capital's purchasing power. Let's take See's Candies as a concrete example. See's is a premium chocolate company that Berkshire Hathaway owns, and one of the reasons Warren Buffett loves this business is its ability to raise prices consistently over time. In fact, See's has increased prices by roughly 5% every year for the last 50 years. Why does this work? Because customers love the product and are willing to pay a little more each year without hesitation. These steady price increases allow Seas to keep up with inflation, cover rising costs like sugar, labor, and packaging, and continue growing profits. Here is the impact. If a box of chocolates cost $1 in 1975, a 5% annual increase means that over 50 years, the price has compounded to about $11 to $12 today. That is pricing power in action. A simple, consistent strategy that preserves the company's profitability and protects investors' purchasing power against inflation. Buffett often calls Seas a prototype of the kind of businesses we love to own forever, and the 5% annual price increases over decades are a perfect example of why. This is in stark contrast to fixed dollar assets, which cannot adjust to rising costs. Now let's look at some real data to see this principle play out on a broader scale. This chart shows the S&P 500 dividend growth compared to US inflation from 1950 to 2024. As you can see, the blue line representing dividend growth has on average and over the long term consistently outpaced the red line of inflation. This is a powerful visual validation of Graham's thesis. However, notice the significant volatility. The sharp drop in dividend growth during the 2008 financial crisis is a clear example of how stocks can be vulnerable in the short term. This reminds us that owning stocks is not an absolute guarantee against inflation, but it offers the best chance of overcoming it over the long haul, especially when you focus on high-quality businesses. Let's go back to the book now. On page 52, Graham writes, "The only way that inflation can add to common stock values is by raising the rate of earnings on capital investment. On the basis of the past record, this has not been the case. This is also a very important point. Inflation doesn't automatically mean that it's good for companies or stock prices. The only way the stock of a company can benefit from inflation is if, because of inflation, it achieves a better return on its invested capital, its ROIC. Return on invested capital is basically a measure of how efficiently a company uses its money to generate profits. Think of it this way. If you give a company $100 to invest in their business, ROIC tells you how much profit they can generate from that $100 each year. For example, if a company has a 20% ROIC, that means for every $100 of capital invested in the business, they are generating $20 in annual profit. The higher the ROIC, the better the company is at turning money into more money. So what Graham is saying is this. For inflation to actually be good for a stock, the company will need to become more profitable per dollar invested because of that inflation. Here is a simple example. Let's say a company normally makes $10 in profit for every $100 they invest in their business. That's a 10% ROIC. For inflation to benefit this company, inflation would somehow need to push that return up to, say, 12% or 15%. But here is the problem Graham identified. Inflation typically doesn't work that way. When inflation hits, yes, companies can often raise their prices, but their costs usually go up too. Their raw materials cost more, they have to pay workers more, their rent goes up, and everything gets more expensive. So, even though they are making more dollars in revenue, they are also spending more dollars on expenses. The net effect: their return on invested capital often stays the same or even gets worse. Then Graham adds this. In the economic cycles of the past, good business was accompanied by a rising price level and poor business by falling prices. This is very important, and here is what Graham means. The businesses that historically did well during inflationary periods weren't just any businesses. They were good businesses, the ones with real pricing power. Think about it this way. When everything gets more expensive, strong companies with competitive advantages can raise their prices and customers will still pay. See's Candies can charge 5% more for their chocolates because people buying premium gifts aren't shopping around for the cheapest option. A dominant utility company can raise rates because customers have no alternative. But weaker businesses, they are stuck. If a generic restaurant tries to raise prices too much, customers will just go to the competitor down the street. If a commodity producer tries to charge premium prices, buyers will find someone else selling the exact same product for less. So Graham's point becomes more clear. Historically, when good business was accompanied by rising prices, it was because strong businesses with pricing power could successfully navigate inflation while weaker competitors got squeezed. The inflation didn't make all businesses better. It was like a stress test that revealed which companies had real strength and which ones were just getting by on easy economic conditions. Let's move on with our analysis. On page 54, Graham writes this. The stock market has considered that the public utility enterprises have been a chief victim of inflation, being caught between a great advance in the cost of borrowed money and the difficulty of raising the rates charged under the regulatory process. But this may be the place to remark that the very fact that the unit costs of electricity, gas, and telephone services have advanced so much less than the general price index puts these companies in a strong strategic position for the future. They are entitled by law to charge rates sufficient for an adequate return on their invested capital, and this will probably protect their shareholders in the future, as it has in the inflations of the past. This is a really interesting point. At first glance, you might think utilities get badly hurt by inflation. When inflation spiked in the 1970s, utilities were caught in a painful squeeze. Their borrowing costs skyrocketed as interest rates went up, but they couldn't immediately raise the prices because they needed regulatory approval for the rate increases. But utilities companies have something most companies don't have: legal protection. Think about it. If you run a restaurant and inflation hits, you can try to raise your menu prices, but customers might just stop coming. You have no guarantee that you'll be able to maintain your profit margins. But if you are a utility company, you have a legal right to charge rates that give you an adequate return on your invested capital. The government can't let you go out of business because people need electricity and gas. And this graph provides compelling evidence for Graham's thesis. During major inflationary periods, we can observe a consistent pattern. Utilities initially suffered severe losses. In 1973-1974, recorded substantial negative returns of 17 and 25% respectively. However, the regulatory adjustment mechanism then kicked in. Within just a couple of years, utilities delivered exceptional returns, plus 14% in 1975, followed by a remarkable 36% in 1976. This same pattern emerged during other inflationary episodes throughout the data. So Graham's point is simple but smart. Utilities might struggle at first when inflation hits, but they are guaranteed to recover because the law says they have to make a fair profit. While other investors got scared and sold, Graham showed that utilities were actually good protection against inflation in the long run. Now, on page 55, Graham talks about gold and whether it is a good hedge against inflation. The standard policy of people all over the world who mistrust their currency has been to buy and hold gold. This has been against the law for American citizens since 1935. Luckily for them, in the past 35 years, the price of gold in the open market has advanced from $35 per ounce to $48 in early 1972, a rise of only 35%. During all this time, the holder of gold has received no income return on his capital and instead has incurred some annual expense for storage. Obviously, he would have done much better with his money at interest in a savings bank, in spite of the rise in the general price level. Here Graham says that gold is not an effective hedge against inflation. At some periods, like the period he mentions, gold returns are very low. For example, from 1935 to 1972, a 37-year period, gold rose from $35 to $48 per ounce, which is only about 0.8% per year compounded. Meanwhile, it produced no income and required storage costs. Graham's point is clear. Even a basic savings account earning 3 or 4% annually would have crushed gold's performance over this period. Gold fails as an investment because it doesn't produce anything. No dividends, no interest, nothing. It just sits there, hoping someone will pay you more for it later. Now, to be fair to gold, there have been periods where it absolutely crushed inflation. The most famous example is the 1970s, when gold went from $35 to over $800. Inflation at that time was running at double digits, and gold provided spectacular protection during that crisis. More recently, gold surged from around $300 in 2001 to over $1,900 in 2011, and it hit new heights above $3,700 as of 2025. But here is Graham's crucial insight. You can hold gold for decades and actually lose money. Let's now move on to the commentary of the chapter by Jason Zweig. On page 60, he writes, "Since 1960, 69% of the world's market-oriented countries have suffered at least 1 year in which inflation ran at an annualized rate of 25% or more. On average, those inflationary periods destroyed 53% of an investor's purchasing power. We will be crazy not to hope that America is somehow exempt from such a disaster, but we will be even crazier to conclude that it can never happen here." This is a very important comment. The US since the 1950s has had a few periods of high inflation. Just a couple of years ago, inflation hit 8%. But don't be fooled by this relatively mild experience. 69% of all capitalist countries have had years of very high inflation, over 25%. My own country, Greece, suffered from very high inflation rates for years. In 1974, for example, inflation in Greece was 26.9%. Also, take a look at Turkey. Just a couple of years ago, it had inflation of 72.3%. Zweig's point is crucial. Americans has been incredibly fortunate to live through a period of relatively stable monetary policy, but that stability isn't guaranteed forever. When you look at the global picture, extreme inflation isn't some rare historical accident. It's actually the norm for most countries. The US has been the exception, not the rule. This is why Graham's lessons about inflation protection are so important today. You might think that's a problem for other countries, not here, but history proves that is just not the case. Even nations with strong economies and stable governments have experienced a complete breakdown in monetary stability. The key takeaway is that you have to be prepared. Instead of just hoping the good times last forever, you should own assets that can adapt to changing times. Businesses with real pricing power that can protect your purchasing power. That's the core of what it means to be an intelligent investor in an inflationary world. Here is another key point from the commentary of the chapter. Rising prices allow Uncle Sam to pay off his debts with dollars that have been cheapened by inflation. Completely eradicating inflation runs against the economic self-interest of any government that regularly borrows money. Believe it or not, governments actually benefit from inflation. Here's why. A government is essentially a borrower. It issues bonds to raise money to fund its operations, and these bonds are promises to pay back a fixed amount in the future. When inflation rises, the real value of those fixed payments goes down. For government, this means they are paying off their debts with dollars that are worth less than when they were borrowed. This is why Jason Zweig's point is so important. For example, during its debt crisis starting in 2010, Greece borrowed a massive amount of money from international institutions. Now, with recent inflation rates in Europe at one point reaching up to 10%, the real value of that debt is shrinking. This makes the debt burden feel lighter for the government, even though the nominal amount owned remains the same. In stark contrast, the purchasing power of the Greek people has gone down dramatically due to the very same high inflation. While the government's debt gets easier to manage, the savings and fixed incomes of ordinary citizens by far less, illustrating inflation devastating and unequal impact. This dynamic creates a conflict of interest. While the public wants low and stable inflation to protect their savings and income, a government that regularly borrows money has an incentive to let inflation run a little high to help pay off its massive debts. On page 61, Jason Zweig writes, "The historical evidence is clear. Since the advent of accurate stock market data in 1926, there have been 64 5-year periods. In 50 of those 64 5-year periods, or 78% of the time, stocks outpaced inflation. That's impressive but imperfect. It means that stocks failed to keep up with inflation about 1/5 of the time." Here is something we also mentioned before, but it is crucial to remember. Stocks are not a safe haven that protects us from inflation every single time. So, what do we take from this? Graham and Zweig are reminding us that stocks are not magic shields against inflation. They are probabilistic protection, not guaranteed protection. Over the long term, history shows that well-chosen stocks, especially those of companies with durable competitive advantages, tend to beat inflation. But in the short term or during severe crises, stocks can and often do fail to keep pace. That's why, as intelligent investors, we should avoid extreme thinking. Don't assume that bonds, cash, or gold will always protect you. Don't assume that stock will always save you either. Instead, think in terms of probabilities, resilience, and preparation. Let's move on. On page 62, we find this chart. It shows US inflation rates and stock returns for each year between 1926 and 2002. But be careful, they are not arranged by date. Instead, they are sorted from the lowest inflation years on the left to the highest inflation years to the right. The black bars represent the inflation rate. The gray bars represent the stock market's total return. Now look at the pattern. On the left, when inflation is negative or very low, stock returns are often weak or negative too. In the middle, when inflation is moderate, say 1 to 5%, stocks generally do very well. This is the sweet spot for equities. But on the far right, when inflation spikes into double digits, stocks break down as a hedge. Returns become erratic, and in many cases, investors lose more than 10% in real terms. So, what's the lesson? Stocks are not a perfect inflation hedge. They work best in times of moderate inflation, but in extreme conditions, whether deflation or runaway inflation, they can fail badly. On page 63, Jason Zweig writes that since Graham wrote this chapter, there are some other tools that help the investor fight inflation. One of these is this. Real estate investment trusts, or REITs, are companies that own and collect rent from commercial and residential properties. Bundled into real estate mutual funds, REITs do a decent job of combating inflation. While a REIT fund is unlikely to be a foolproof inflation fighter, in the long run it should give you some defense against the erosion of purchasing power without hampering your overall returns. The reason real estate is such a powerful long-term hedge against inflation comes down to two simple forces: rising property values and rising rents. When inflation pushes the price of goods and services higher, the cost of construction materials, labor, and land also goes up. That means it becomes more expensive to build new properties. As a result, the value of existing real estate often rises because it would cost much more to replace it. Investors who already own property benefit directly from this scarcity effect. At the same time, rental income tends to adjust upward with inflation. Landlords can raise rents to keep pace with the higher cost of living, especially in markets where demand for housing or commercial space remains strong. Unlike a fixed bond coupon, rental payments are flexible, they reset over time, providing a natural inflation adjustment mechanism. So, in practice, owning real estate, whether directly or through REITs, gives you two layers of protections. Your asset itself typically appreciates in value, and your income stream increases as rents rise. This combination makes real estate one of the most resilient asset classes in inflationary environments. That's why Jason Zweig highlights REITs as a valuable modern tool. They allow everyday investors to tap into the inflation-fighting power of real estate without needing to buy and manage physical property themselves. And with that, we'll conclude our analysis of Chapter 2, Benjamin Graham's timeless wisdom, amplified by Jason Zweig's modern commentary, gives us a powerful and nuanced understanding of what to do in times of inflation. Join me in our next video as we dive into Chapter 3, where Graham takes us on a journey through a century of stock market history. Don't forget to like, subscribe, and hit the notification bell. See you next time.